In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India's paint industry is facing a demand slowdown, rising competition, and also shrinking margins all in one go. And in the second story of the day, I'll talk about why India's consumption engine is losing steam now and what that really means for our economy's future. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 27th of May. See, if you think about it, most of us decide to paint our homes when we are feeling good. It could be a festive occasion, a family celebration, or maybe the start of a new season. Now, all of these are moments when people want their homes to feel fresh and also full of life. But on the other hand, when times are difficult and people are trying to save money, one of the first things they skip is a home paint job. Because after all, it's not really an urgent expense, right? And that is why, oddly enough, the demand for paint can actually tell you a lot about how confident people are feeling about their lives and also their money. Basically, if the demand is strong, it usually means that people are feeling good. But if it slows down, something's definitely off. And in the fourth quarter of FY 2025, the paint industry in India got a bit of a reality check. See, for many paint companies, demand was not what they had hoped for. Big players like Asian Paints and Berger Paints saw consumer behavior shift in unexpected ways. There was also a new heavyweight that entered the market, which added a lot more pressure. Profit margins did not behave the way they do, and the entire industry seemed to be navigating through a very difficult phase. So with that context in place, let me very quickly break down what exactly happened for you. See, to begin with, the overall demand was fairly weak, and it was not a one-size-fits-all situation. In fact, the story actually played out very differently in cities versus villages. In big cities, demand remained fairly soft because urban consumers, especially the ones in metro cities, were hesitant to spend on anything that was not essential to them. So they delayed or even skipped painting their homes altogether. And this was not a new trend, by the way. Demand has been slowing down for a few quarters already, but this particular one hit a little bit harder. Asian Paints, which is the biggest player in this space, said this was the worst demand environment in 2 decades. Now that of course is a huge statement, and it really tells us all a lot about how serious the slowdown really was. But that said, if the urban story was negative, the rural picture actually brought a small ray of hope here. See, paint companies reported that demand was starting to pick up in smaller towns and villages. After being fairly tight on money for quite some time, especially during the post-COVID slowdown and inflation, rural consumers were finally beginning to loosen their wallets up for painting jobs. Now mind you, this was not a massive jump, but there were still some signs of recovery. Some experts felt that a good harvest or hopes of a strong monsoon might have sort of helped nudge people in rural India to consider painting their homes once again. But that said, the rural recovery was still not strong enough to make up for the urban slump. So if you look at the overall picture, the industry demand remained subdued. Now what made the situation even interesting was how consumers were choosing what kind of paint to buy. See, over the last few years, paint companies have been trying to get people to shift to premium products. You can think of things like washable interior paints which look fancier, or maybe exterior paints that can handle harsh weather a little better and also last a little longer. Now these premium products obviously come with higher margins, so companies have been keen to push them. Now for some players, the premium push worked very well. Berger Paints, for instance, said that it saw strong growth in its premium emulsion category, and they continued to focus on high margin offerings like luxury paints and waterproofing solutions. But for the others, it was a very different story. Many consumers who were feeling the pinch of high prices and economic uncertainty started to downgrade, which basically means that they opted for cheaper paints or they switched to local and unbranded options. And this shift affected sales value in a very big way. Companies were still able to sell more liters of paints in many cases, but the total money that they made from those sales did not grow as much. In fact, it actually fell in some cases. And that is because companies had to cut prices and offer discounts in order to attract cost-conscious buyers and also keep up with rising competition. Asian Paints is a great example of this. They managed to grow their sales volume slightly by about 1.8% in their key decorative paints category, but their revenue actually dropped by 4%. Why, you might be wondering? Because they slashed prices by more than 5% while trying to stay competitive in the market. Also, by the way, that particular price cut that I'm talking about was partly in response to something very big that had just happened in the industry. A new player, which is Birla Opus, which is the paint brand launched by Grasim Grasim Industries from the Aditya Birla Group had recently entered the game. And they did not do this quietly. Grasim had announced its entry into paints back in 2024, and within just 1 year, it has set up 5 massive plants across the country, which makes Birla Opus the second largest decorative paint company in the country by manufacturing capacity. Now, that kind of speed is almost unheard of in this industry, where setting up a single plant can usually take many years. But that said, capacity is only one part of the story. The real test is whether you can actually sell what you make, right? And on that front, Birla Opus did not disappoint either. In the March quarter, Grasim claimed that Birla Opus had already captured a high single-digit share of the decorative paints market in terms of revenues. Now, that is a massive achievement for a brand that has barely been around for a year. And that said, naturally, this shook up the entire paint sector. Legacy players like Asian Paints, Nerolac, etc. had for a very long time enjoyed a stable market with relatively predictable competition. But suddenly, there was a new and very well-funded competitor who was willing to play aggressively in this space. And therefore, to respond, Asian Paints was almost forced to make these price cuts. But along with it, Asian Paints also made it very clear that it does not really want to get into a long-drawn price war as such. And instead, it actually wants to protect its brand value and focus on delivering better quality service. But the other companies actually did not respond like Asian Paints, and they responded a little bit differently. Berger Paints, for instance, stuck to its strategy of focusing on premium products and operating efficiently. Its leadership pointed out that Birla Opus was essentially buying market share, which means that it was spending heavily in order to grow fast, and they questioned whether that approach would be sustainable in the long run. Now, interestingly, Berger managed to gain market share in decorative paints during this quarter, which also suggests that its strategy may be holding well so far. But that said, meanwhile, one more competitor is quietly trying to make a mark here, which is JSW Paints. See, while it is still a very small player in the paints industry, there is growing speculation that they might try to acquire Akzo Nobel India, which by the way owns the Dulux brand, in order to gain a stronger foothold in the market. And if that happens, the competitive landscape could shift even more dramatically all of a sudden. So with all of this chaos in place, the big question is, what has really happened to profits and margins for these companies? See, one piece of good news here was that raw material costs came down this time around. The thing is, paints heavily depend on inputs like crude oil derivatives and titanium dioxide, and prices for these very inputs has softened recently, which gave companies a chance to improve their margins. But that said, that benefit did not really fully translate into higher profits. That is because companies had to spend a little more money in other areas like advertising, dealer commissions, and promotional schemes so that they could hold on to their market share in the face of rising competition. And in many cases, they also passed on the cost benefits to customers via price cuts instead of keeping the extra margin to themselves. For example, Asian Paints saw their material costs drop, but they also spent more on marketing and distribution. And as a result, their consolidated net profit fell by a massive 45% year over year, down to 692 crore rupees. Now that of course is a big drop. But that said, it is worth noting that this figure also includes a one-time loss from selling its Indonesia unit, which pulled the profit number down even further. But even without that, pricing pressure and competition clearly affected the bottom line for them. Revenues dropped and margins shrank. That said, currency movements added one more layer of challenge here. Even though global prices for raw materials were down, the falling value of the rupee made imported chemicals a lot more expensive. So the benefit of cheaper materials was partly offset by currency headwinds. But that said, it was not all bad news for everyone. Berger Paints, for example, actually had a good quarter. Its net profit rose by 18% year over year, which was helped by a strong volume growth and better cost control. And unlike some of its peers, it actually managed to grow without cutting prices too much, which helped protect its margins. So if I were to summarize everything here, the fourth quarter of FY 2025 was a quarter full of contradictions for the Indian paint industry. Demand was weak in cities, but it showed some signs of life in villages. Prices were under pressure, but volumes held up for some companies. Margins should have improved with lower input costs, but rising competition and higher marketing spends and other spends ate into all of those things. And just when the older players were settling into a bit of a rhythm, a powerful new competitor arrived and sort of rewrote the entire paints industry playbook. On that note, let's move on to the second story of the day. See, most of us don't think about it too often, but if you had to describe what really drives India's economy, the answer is actually surprisingly simple. It is us. Ordinary people spending money on ordinary things like groceries, medicines, school fees, clothes, mobile phone, even Netflix subscriptions, and so on. In fact, nearly 60% of India's economy is made up of something called private final consumption expenditure. Now, that is basically just a fancy term for what households like yours and mine spend on a day day-to-day basis on needs and wants that we have. In very simple words for you, if we ever stopped spending hypothetically, the entire economy would slow down. And that, unfortunately, is the concern right now. See, for a brief period after the pandemic, it looked like India was back on track. Between 2021 and 2023, our consumption numbers rose very sharply, first by 11.7% and then by another 6.8%. Now, this helped the GDP bounce back as well, and it gave the impression that we were back in business. But now it suddenly seems like that growth was very temporary, and it was more of a reaction to the chaos of the COVID years than actually a sign of strong underlying health of the economy. It was a recovery and not really a boom as such. To give you context, by FY 2024, the growth in consumption had already started to slow down. It fell to 5.6%, which is below our long-term average. And this is not just a one-off blip, mind you. The more you dig into the data, the more you will realize that our problems might have started much earlier, which is well before the pandemic as well. I'll rewind a little bit and explain this to you. See, between FY 2015 and FY 2017, India's consumption was growing at a solid 7.9% annually. But between 2017 and 2020, that pace dropped to 5.7%. Now, that slowdown was not random. It happened during a time when the overall economy was slowing, investments were stalling, and the financial sector was going through a bit of a crisis. And by 2020, GDP growth had dropped to just 3.9%, which is the lowest that it had been in a decade. And then came COVID-19, and for a year, everything sort of fell apart. People lost jobs, incomes fell, and fear almost took over all of our lives. Nobody, of course, wanted to spend unless they absolutely had to. But the thing is, once vaccines rolled out and the world reopened of sorts, people rushed back to normal life. There was a pent-up demand of sorts, and many of us went on a sort of revenge spending spree, which was buying things that we had held off during the lockdown. This is especially true for big ticket stuff like electronics, vehicles, clothes, and even furniture. And that is where the data started showing some very sharp spikes. Between FY 22 and 23, consumption of durable goods, which is things like appliances, cars, electronics, etc., jumped by 22.7%. And semi-durable goods, which are things like shoes, clothes, bags, etc., also saw a strong growth of about 15% a year. But that party did not really last too long, like I said. In FY 2024, durable goods consumption growth dropped to just 8%, and semi-durables actually shrank by over 2%. And one of the main reasons for this is that people are not earning enough money. Now, India does not have an official statistic for wage growth across the country, but we do have some rough indicators for this. For example, per capita GDP, which can be seen as a broad proxy for average income, grew at just 3.55% annually in recent years as compared to 6% in the previous decade. Disposable income growth, which is how much money people have left in order to spend after they pay their taxes, also fell from 13.5% in FY 2013 to just 7.7% in FY 2020. And the story continues after the pandemic as well. Urban wage growth has been falling, especially for informal workers, which are the ones doing contract jobs or working in construction or maybe even running small businesses. Now, mind you, this matters quite a lot because most Indians are not salaried professionals. They depend on these informal income sources, and when their earnings do not grow, neither does their spending for obvious reasons. Now, there's a useful way to think about this. Back in 1957, an economist proposed something called the permanent income hypothesis. He said that people spend money not just based on what they earn today, but based on what they expect to earn in the future. So if people think that things will improve, they are willing to spend more amount of money today. But if they believe that their future income will be uncertain or lower, they will cut back even if they have money in hand right now. It's basically a matter of confidence in many ways. And that confidence right now has maybe been missing a little bit. To give you some context, the RBI runs regular consumer confidence surveys, and ever since 2019, the data has mostly been negative. During the COVID period, confidence had completely collapsed for obvious reasons. Of course, it has recovered somewhat ever since then, but still it has not crossed the threshold that separates optimism from pessimism as such. So basically, for nearly 5 years now, most Indians have not truly believed that their financial future is really secure. But that said, there's one more major factor that is making things worse, which is inflation. See, prices have gone up across the board, but for poorer families, food inflation has been especially brutal. Between FY 2022 and FY 2024, food inflation rose to make up over half of total inflation, which is 55% in FY 24 and even 67% in the first half of FY 2025. Poor households spend a much bigger chunk of their earnings on food. So even if wages grew a little bit, most of that increase was actually wiped off at the kirana store or the sabzi mandi if you think about it. Now mind you, this is not just theory that I'm talking about. We have actual data on rural inflation and wages to back this claim up. The Consumer Price Index for rural laborers, which tracks the prices of things that rural workers typically buy, FY rose an average of 7% between FY22 and FY24, but rural wages during the same period grew at just 6.5%. Now that means people effectively got poorer. Adjusted for inflation, their incomes barely moved and grew at only 0.1% every year. And if you compare that to the period between FY14 and FY19, real rural wages were growing at over 2.3% annually at that time. Basically, the difference here is massive, and it explains why demand for everyday goods, right from soaps and shampoos to clothes and even shoes, has remained so weak. Basically, people's incomes at scale is not growing, and the little that they earn is also getting eaten away by inflation. They simply have no room left to spend. But that brings us to a slightly more puzzling question. If incomes were weak and inflation was high, how did consumption rise so much between FY22 and FY23? The answer seems to be credit. People borrowed, and a lot of it. India's household debt has been rising very fast. In FY15, it was 31% of GDP, and by FY 2023, it was almost 40%. And by mid FY25, it has crossed 43% as well. Now that, of course, is a very sharp rise in just a few years. And it's not even just the amount of debt, it is the kind of debt that is becoming problematic. Earlier, most of the borrowing was for home loans, but now a big chunk of it is actually for personal loans, which is the money borrowed for weddings, mobile phones, hospital bills, or even groceries for that matter. The share of these consumption-linked personal loans rose from 21% in FY16 to over 32% recently. And this borrowing binge basically gave the economy a temporary boost. But it's almost like a sugar rush, and it did not really last, of course. Between FY22 and 23, household debt rose by 17.5%, which far outpaced consumption growth. And that's why now the consequences are starting to show up. More people are stuck with multiple loans, repayments are getting delayed, and delinquencies are rising, especially for smaller ticket loans under the cost of 50,000 rupees. The RBI has warned that over 40% of borrowers now hold more than one loan account, and that is a bit of a dangerous territory that we are in. And the scary part is that we've seen this happen before. The last time India's consumption had collapsed, it was very closely linked to a financial crisis in the NBFC sector, partly triggered by bad loans and rising debt stress among households. And if we're not careful this time around, we could see a repeat of that. But that said, there are a few reasons to be optimistic as well. See, for starters, last year's monsoon was great, and that led to a strong kharif crop and better rural incomes. The agricultural sector is likely to grow at 3.8% in FY 2025 compared to just 1.4% in the year before that. The government has also increased spending on rural schemes like Manrega and infrastructure by 20%, which could push some money into people's hands. Also, past trends show that when the government spends more in rural areas, private consumption also tends to rise. And meanwhile, inflation has also begun to cool off, which also gives RBI a chance to cut interest rates. Now that should, in theory, at least reduce EMIs and also make borrowing a little bit easier for people. And all of it might offer a temporary lift to consumption. But that said, let's be honest, none of these are permanent fixes. Another bad monsoon or a small surge in food inflation could sort of knock off everything off the balance once again. And as long as wage growth remains low, household debt remains high, and people lack confidence in their financial future, India's consumption story will remain fragile. It's basically not an economic problem as much as it is a psychological one. Because at the very heart of it, to be honest, growth not only depends on how much money people have, but on whether they believe that they will have it tomorrow. And that very belief in the future, in the system, and in upward mobility is what we need to rebuild as a nation. That brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India has overtaken Japan to become the fourth largest economy globally, according to Niti Aayog's CEO. The IMF's April 2025 World Economic Outlook projects India's GDP for FY26 at $4.187 trillion, which is marginally ahead of Japan's $4.186 trillion for the calendar year of 2025. Second, India's import duty concessions for the automobile sector under the proposed free trade agreement with the UK will be implemented gradually over a 10 to 15-year period. According to a senior official, the offer is structured with specific relaxations linked to engine capacity and vehicle prices. The concessions are not uniformed but designed with segmented conditions to limit market disruptions. Third, Ashok Leyland reported a 5.7% year-on-year rise in standalone revenue for Q4 of FY 2025, reaching 11,857 crore rupees, supported by 5% volume growth. EBITDA growth was 12%, which was aided by softer raw material costs. EBITDA margin expanded by 90 basis points year-on-year to 15%, while net profit rose 30% due to stable depreciation costs. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.